Welcome. This is the June webinar from Principal Wealth. I'm Julina Ogilvie, partner and wealth advisor, joined as always by Bob Paolucci, our founder and CEO. The title this month is Never Never Land. And Bob, you were the one that created the title. So I guess I'm going to start by asking you, I don't know if you think we're Australia or if you think we need to grow up or if there's something else behind this title.
There's a lot of emotion going on politically in Washington, and it seems like emotion comes from false expectations or wrong expectations. And we're hearing about the pushing of this big, beautiful bill and the emotion that comes from it, right? There's a lot of back and forth, and there's a lot of fighting, both within parties and between parties. And why are we acting like we're in Never Never Land, which is this faraway imaginary place where everything is perfect?
Hmm.
What did we think was going to happen, right? If you're a politician, you're doing a lot of grandstanding, you're doing a lot of fainting on purpose. There's a lot of emotion in theater. And that is all to get the people watching it play out to feel their pain and to act and respond, so on and so forth. So if we thought passing bills was easy, I mean, shame on us. We are not in Never Never Land. If we thought investing in markets, fractional shares of the ownership of companies called stocks is pain free and smooth, this is not Never Never Land. How about the fact that investing in bonds is also not pain free and smooth? There's
Hmm.
risk everywhere. And we need to get our mindset out of Never Never Land and into the real world to have proper expectations and to have a better mindset and to remain in a better mood. Expect that there's going to be turbulence everywhere. As long as you realistically understand that the Washington machine of politics will continue to lie, deceive, cheat, steal, and provide theater, you'll be able to handle that a little bit better. If you understand that the capital markets will be the crazy place that they always are, you'll be able to handle the volatility a little bit better as well.
There you go.
And hence the title Never Never Land.
Well, I was also going to add that, these cute titles that you've had the last few months here, the pressure's on that we got to continue it. So,
That's right. That's right.
yeah.
Yeah.
So the agenda for today, keeping the normal cadence, we do want to revisit the January outlook because we did have drivers of growth for this year. And I think as we're approaching the mid-year, this is an important time to readdress really what has come from that. And then we're going to follow with our cadence of the markets, the economy and policy and everything else. Well, Bob, let's revisit the January outlook. I have to say, we were fairly adamant about our outlook. And now that we're almost halfway there, it's really interesting to see what's transpired.
Yeah. As we approach halfway, and be mindful that July, really halfway through the year, our next month outlook will be a half year outlook. Back in January, we were crafting up these ideas here and trying to rank them based on the weight in which they would influence the capital markets and the economy. And we really came up with this outlier that wasn't on many radars out there. The 10-year Treasury yield would act as the boss or the moderator of the capital markets and the economy, and maybe even some decisions policy wise. And so far, we've been pretty spot on with that. The 10-year Treasury is like the benchmark interest rate. It's let's call it, the biggest, most liquid security in the world. It sets the tone for other interest rates, other lending rates, comparison rates. There's a lot of stuff that goes on, and that gets priced into that yield, whether it be policy, people, emotion, war, recession, depression, currency change, the direction of stock markets, liquidity, whether it be companies or countries that need liquidity, the Fed that may need liquidity, the cumulative stuff in noise all sort of gets priced into the biggest, most liquid, most invested in security in the world, which is the 10-year Treasury.
Mhm.
And from that, you can, it spawns these tea leaves that you can read. We had mentioned that if the rate got to 5% or higher, which it hasn't in 15 years, not once, then that wouldn't be a great thing for the capital markets. The stock market would very likely be capped by a very high 10-year Treasury. We thought it would range somewhere between 4 and 5% for the year. And so far, we are spot on with that. And the lower it gets, the higher the market can go. The higher it gets, the more capping it will do to the capital markets. Does that make sense?
And that's primarily driven because that becomes the competitor to stock return.
You're absolutely right. Yep. And it also influences, if it gets too high, higher lending rates,
Correct.
right? We then stacked ranked. We thought, policy, all flavors of policy, monetary, fiscal, and trade would be a big influencer of the economy and capital markets. And I think we're pretty spot on with that one. We have this pending monetary policy debate, whether the Fed will cut now or certainly cut later and cut more later if they don't cut now. Fiscal, obviously, we're talking about the one big bill. And then there's trade, and who hasn't heard about trade? And then we put regulation third. So I think if we were wrong, regulation should probably be number 5. Employment should be 4. Employment should be 3. Earnings should be 4. Regulation moved down to 5. But regulation, there's going to be less of it, and less of it usually creates some other activity like mergers and acquisitions and some other stuff. We have seen the influence on IPOs, companies going public. We've seen an increase in IPOs. We do believe that the second half of the year, mergers and acquisitions will pick up. That is another good thing for the economy and capital markets. Employment, we thought, being the other Fed mandate, inflation and employment, would be the driver of the Fed making a decision. And I still believe that is the case because inflation is low. It's right in the target zone, according to the Fed. And I think they are just waiting for employment to creep up. And it has. We now have an unemployment level of 4.2. We had a weak-ish jobs report this morning. Yeah, and I think the Fed certainly has enough data at this point to make a decision to cut rates next, I think in 10 days they meet mid-June. If they don't, it may be shaping up very similar to last year. Let me just remind you at this point, the second half of last year, when they were rumored to cut rates and they didn't, they hit the month of September. And because they hadn't cut and the markets and economy wanted to cut, they did a 50 basis point cut, not 25. So they did a twofer. And then they cut an additional 2 times before the end of the year. So the expectation by many last year was they'll cut once or twice. They cut 4 times, right? The Fed was also saying, we may not cut, or it might be 1. They cut 4 times. This
was
year,
more in line with our expectation.
Yeah, which was right in line with our expectation. This year, they seem to be following the same path where they're talking a certain way, slowly and subtly around. We think we can do this. We're not sure. We're going to wait another month. We'll push it to this meeting. Who knows? They may be trying to replicate the strategy they did last year, which was don't blink until September and then go big in September and follow up with 2 more. I'm thinking that the fact that short-term interest rates are double the rate of inflation, which creates that delta, creates a bit of a milking of the economy, that they are going to do something more than what's expected. And if they don't do something in June, they better be talking about what they're going to do in July. And if they don't do anything in July, I'm going to go out on a limb and say there's going to be a 50 basis point cut in September. The reason why I say September is August. They meet, but it's a vacation meeting. So they typically don't make any decision at that meeting. It's in Jackson Hole. So they may come back and do a lot more in September, if that's the plan. But we're going to find out very soon. But, going back to employment was the outstanding data point, the other mandated piece that they wanted to fall in line. So in essence, in English, they wanted more unemployment to justify the Fed cuts. Well, I mean, we're in the 4s. We were 3.6 a year ago. Okay, what are you waiting for?
It's nudged, yeah.
Yeah. And then we talked about, the power of earnings and buybacks, simply from a fundamental lens. If businesses have positive earnings and they're growing their earnings, and they're buying back stock, that means they have liquidity and confidence, but also they also have results, right? So earnings have done incredibly well. Expectations got weaker, but earnings didn't. So we love when that happens, and that's why the market goes up. And buybacks and announced buybacks have increased. So our top 5 drivers of the market for 2025 that we laid out in January seem to be quite accurate in doing their job and playing out nicely for us. So we just wanted to repeat that because those are still, through our lens, key drivers from here on out. So,
which is incredibly important when you think back to January and looking back, it's so easy to see after we've experienced what we have over the last 5 to 6 months. That's a really good segue of going into the markets and talking about May after this reversal from the April drawdown. May was incredibly strong, which surprised a lot of people. Some of that was due to the ease of the trade tension, but also part of that was due to the large caps having an earnings surprise, which was the highest, I think, in 10 years.
You know, that's the quote in earnings surprise, but companies weren't surprised. Companies knew what their earnings were going to be. They didn't even change their forecasts.
Hmm.
They just reported earnings.
Yes,
Wall Street expectations came down, and I guess investor expectations came down
for sure.
for reasons that were related to emotion around trade and politics, and then these companies come out with earnings and everything's fine.
So the S&P, if you look at the slide, was up 6.2. The NASDAQ, right, which had even more volatility in the beginning of this year, was up 9.5.
Yeah, the month of May was the best May for the S&P 500 in 35 years. Coming out of April, which ended the month flat just about,
Hmm.
the first week of April was horrendous. We invested heavily for our clients on April 7th. But again, it just shows you if you have a good fundamental backdrop and you buy big, inefficient declines in the markets and you buy high quality securities that can weather storms, you don't have to wait long to get good returns. You just have to lean into the volatility and turmoil and the bad news and hold your nose and invest sometimes, and you quickly see how things change, right? We always talk about, if you've heard these videos, the best days come directly after the worst days, the best months come directly after the worst months. And that will likely be true for the rest of the existence of the capital markets.
And I think that's a great segue into the next slide, which is my favorite slide of this month because
Mm-hmm.
it shows exactly that. So you're looking at the 15 best 27-day route trading days, right? Going back 75 years. And you'll notice that the 3 month, the 6 month, the 1 year, the 2 year, the 3 year, the 4 year, the 5 year are all in green except for one 3 month period in the financial crisis.
Mm-hmm. Yeah, and understandably so for that one. But you're right. Look at the bullish activity. So whenever you have this bottoming of a market and a quick reversal up, the forward returns are amazing. These are cumulative on the right-hand side, but cumulatively, the average 5-year return when you have one of these rallies is 140%. I mean, sign us up for that right now.
Yep,
That's the
absolutely.
average. I'll take the worst one, which was number 9, which was 71%. I mean, 71% over the next 5 years cumulative is also blockbuster.
Yeah.
So things are looking up, everybody.
The other thing that I took note of on this slide that you just made the comment, we said this last month that some of the best trading opportunities and best days are within right after the worst. And if you look at these 15 biggest rallies, 7 of them are during the financial crisis.
Yeah.
Imagine how many people that made that emotional decision to walk away and missed out on that opportunity.
Yeah.
And speaking of emotions, we have a new administration, which has created a lot of anxiety. And it's just so interesting to see, again, over the last 75 years, what that trend looks like.
Yeah, so this is sort of an analog measuring all of the post-election years, presidential election years. The reason why this is even a data point is, well, think about it. Whenever there is a presidential change, there is changing people and personalities. There's changing, oftentimes, ideals, changing policies. There's a period of unknown as they try to craft their vision and strategic plan for their term or half term, whatever it may be. And there's always volatility that hits right around decision making time, which is typically the spring, like clockwork. So the analog measuring all prior years in aggregate together versus 2025 is quite similar. And you can see that the path, at least in the year after the election, historically is pretty consistently positive. And we tend to agree with the direction of this chart for this year as well.
And continuing along this theme of optimism, all-time highs are coming soon.
Yeah, I mean the Nasdaq is, approximately 5% off of its all-time high. The S&P 500 is, 3 to 4% off of its all-time high. It's amazing. We had so many headlines in January and February about all-time highs, and then nobody's talking about it anymore. But we're so close.
Very
We
close.
could technically have a good week or just another good month, and we'll be back to new all-time highs. We believe we'll be saying stuff about all-time highs often in the second half of this year. There are some key stocks within the market. So, the big seven, Apple, Amazon, Nvidia, Google, Meta, they're all off of their all-time highs. Most of them are off significantly more than the market. But there is diversification and resilience once you get out of the top seven and maybe even into the top 50, top 70, that have picked up the slack to help support the market. So
I'd like to give a shout out to the team because thinking through all this emotion and anxiety that was out there, we as a team, we got together, we had a plan, we did execute on that plan, and it was April 7th.
yeah, which was the bottom of the market, I guess, if you're looking at that chart on the right-hand side, where all those lines go significantly down in a sharp decline way. At the very bottom of that line is when we invested lots of money for our clients. So yeah, all right, kudos to the team.
Yeah. And so speaking, we were talking about earnings prior, so let's talk about corporate profits, which continue to rise, which continues to drive the growth of the markets ahead.
Yeah, the market will move in the direction of earnings over a long period of time, right? You can't measure it daily, can't measure it weekly, can't measure it monthly. But if you measure it yearly, if earnings are up, markets are up. It's simple
Mhm.
as that. And this chart shows that earnings are up and expectations and guidance continues to incrementally rise. That's a very good thing. There is no better fundamental than the direction of earnings being up. And that is what we have, everybody.
And I think another reason for optimism, and candidly, this is probably the one that surprised me the most this month, is the M&A activity to see what it's done relative to other periods of
Yes.
volatility.
Yeah, so when it comes to regulation, the thought was there'll be a lot less regulation. There's a lot of pent up demand for mergers and acquisitions, and there is, but something blew in with the wind that was unexpected, which is trade uncertainty,
Mhm.
and that sort of paused some of that about to execute M&A activity. I believe again, second half of this year, you'll see a huge increase in mergers and acquisitions because there's less regulation. It's a friendlier business environment that will be another positive tailwind for the capital markets. And again, another chart where we are at an extreme level of not a lot of M&A, mergers and acquisitions. We are very likely going to pivot right away from that higher pretty quickly.
Yeah, and we're talking about the opportunity with sort of business cash. And we should also highlight, we don't have it in here this month, but we highlight it all the time, is that investor cash is also at an all-time high.
Yeah, individual and corporate cash, again, right around that $7 trillion mark. So there's a lot of money out there to do these types of transactions, and we will very likely see that play out soon.
Let's transition to the economy and policy, and we're going to start with inflation and ask the question, are we there?
Yeah, we're there. And it's not only my opinion, it is the in writing opinion of the Fed. 2% inflation, according to the way they measure it, which is through PCE, we're there. We're at 2.1%. I don't know. The Fed's going to have a hard time here not doing something because everything, according to their chart of where they need certain levels to be, is in line.
Mhm.
And they need, according to them, these data points to be at certain levels for them to feel good about cutting interest rates.
Right.
Well, we're there. So what are you going to do now? Are you going to jawbone again and try to deflect and push this out and risk losing credibility? Or are you actually going to do something and address the facts that the data has been trending down and is in line with where you want it to be to authorize rate cuts?
I was almost thinking that we should have changed the slide title to "Are we there?" dot dot dot, because when
Yeah.
you look, it's not like we just arrived here. We've been talking about this for a little while. We've been sort of bouncing around this number, and we've been suggesting this for quite some time. And maybe some of the proof of that, again, because we've showed this slide before, is looking at the data, both the PCE, but then also the live data.
Yeah. So all these economic data points that you hear about, the ones that you hear about on TV are all stale. They look backwards, and those are in line. There's also this hidden live calculation that the Fed does now That's called market-based PCE. In English, it's just live. When they measure live, it's below 2%. It's 1.9%. So whether you measure stale or live at this point, both measurements are in line. So let's get going, Fed.
So if they don't get going and cut, do they move the goalpost? Do they move the 10%, 2% target?
They can do whatever they want. What will be the reaction of the bond market and yields and the stock market and a lot of the talking heads and all that fun
Trust
stuff?
in what they're doing?
And oh, mind you, the president who's been screaming already to cut rates.
Yeah.
If they don't cut, they are really going to have to create a narrative around that. And keep in mind, if you're watching this video, if the Fed moves rates to 2% or 4%, 3% or 6%, it's not going to impact you. But it does impact people that need to buy a house, don't have tons of liquidity, have to pay the worst mortgage rates, the highest mortgage rates, because they have no other option. They have to finance cars for 5 and 6 years at the highest rate possible. They have to finance many purchases.
Mhm.
Um, if the Fed has those rates high, if they have their rates high, everything is sort of based off of those
Right.
rates.
Right.
It hurts the people that they don't want to hurt.
And our own
And
debt,
yeah, and our own and the
which I know
cost
we're going
of
to talk about, but
financing the
yeah.
debt in the United States. So, they are partially responsible, whether they see it or not,
Right.
for this new interest expense that is above $1 trillion in this country because the cost of financing the debt has changed. It's changed
Mhm.
because rates have gone up.
Right.
Yeah. So we'll get to that in a second.
We will get to that. I think one interesting comment is over the next couple of months, I think we should be very aware of what we might hear from the media in regards to inflation.
Yeah. So it's funny. We have clients ask us all the time, how have you been so accurately forecasting the rate of inflation? And, when it seems that people on TV, the talking heads, the people that run banks and work for these big banks and get paid to do this, seem to just kind of put their hands up and say, I don't know. And they guess and they're wrong all the time. I can't speak for them, but this is pretty easy. You look at the inflation data, and it's simply a scenario where a number rolls off from last year and a number rolls on to replace it from this year. The old number rolls off, the new number rolls on, and you just, use your fingers to count. So what we have here is an illustration of it. We are about to have a May and June number of inflation. The May and June reports get released in June and July, right? The 1 month lag that are zeros. So there's going to be a zero that rolls off. And if a zero rolls on, there's no change to the inflation rate. If a zero point 0.1 rolls on, the inflation rate rises by 0.1. If a negative 0.1 rolls on, the inflation rate drops by another zero point 0.1. So if there's a time for inflation to increase, but again, this could be like a, a slight increase, it'll be over the next 2 months, reported over the next 3 months, if that makes sense.
And if you can look further forward, right?
Now, if you
All
look
of those
further
inflation
forward,
numbers are higher.
yeah, if you look further forward, I can assure you, come at least now, November, December, January, the inflation number is going to be lower because you have some big dominoes that are going to fall
Yeah.
and very likely replaced with lower inflation numbers. So I don't really care about trade and any perceived inflationary impact. We haven't seen it yet. I don't know that we'll see much of it. I do think that the media is going to do a really good job of scaring people over the next 2 months. If the inflation number that rolls on is greater than zero,
Sure.
they'll blame it on anything they want. It'll be trade. We told you so. It's not that at all. It's the number that rolled off was zero, and the number that might roll on is greater than zero.
Yeah.
So don't believe the hype or the narrative that's going to be sold to you out there. I know it's coming. But again, it's if you look out further, you'll see that there are some higher months that'll also roll off over the next 12 months. So we're quite confident that inflation remains in the twos or lower if you cast out the next 6 to 9 months or so.
So our stance hasn't changed on this.
Hasn't changed at all.
Thank you. And moving along with emotions, let's talk about the consumer confidence
Oh,
of recent.
or as they call it, the soft data, and how the soft data over 90 days turns into hard data. Well, that narrative has gone away because we just had the biggest spike in consumer expectations and consumer confidence in 14 years. So again, don't double down on the narrative of the month because things change pretty quickly. So you all probably remember last month we were showing consumer confidence and consumer expectations plummeted. Well, yeah, because what people were listening to on TV and what their friends were saying was the world is ending, trade has blown up, this is terrible, we're going to have a recession, depression, so on and so forth. Well, of course, that impacts emotions. And when you poll consumers when they're emotional, you're going to get a negative output,
Yeah.
right? So you have this enormous relative positive change from where we were to where we are right now. That changed pretty quickly. I would say this is unlikely to bleed into the hard data,
Right.
the economic data, because people are still spending money. People are still consuming. Planes are still being bought and built. Washing machines are still being bought and built. You know, the economy is moving fine. People are still paying their golf memberships and going to Chipotle and buying $7 lattes from Starbucks. You know, you might be complaining about it, but you're still spending the money.
Yeah. And I
So,
think it's also important that, with this reversal of consumer confidence, we did get a lot of questions saying, well, your outlook must change for the second half of the year. You must be more negative. And when we said consumer confidence was low last month, one of the things we highlighted is that historically, the stock market does very well coming off of these lows. So when you look at consumer confidence where it is today, it's not at a high. It's back at a normal level. And so there's still opportunity even from that perspective for the market to keep going. So I think that's important.
yeah,
Um,
you when consumer expectations, you know, it's you just go back to that old fashioned when the cab driver gives you stock advice. That's usually when consumer expectations couldn't be any higher,
mhm,
right? Nothing can go wrong. It's pristine, so on. And there's no risk. We need to leverage the house to buy stocks. Whenever you hear that, trust me, we are running away
mhm.
pretty quickly and rebalancing portfolios. We are nowhere near there. And you depressed consumer confidence and expectations levels create market inefficiencies. Why? Because it's the emotion that creates a sale, creates
Mhm.
opportunities,
Yeah.
and that exists today still, and that makes us pretty optimistic.
I vividly remember living in Manhattan before the tech bubble burst, and every cab driver would ask you, wasn't Uber, would ask you, are you in finance? And they would give a recommendation of a stock. So
Yeah, yeah,
amazing.
yeah.
So given the fact that some of this rebound in consumer confidence was driven by what's been going on the tariff front, let's talk a little bit about that.
Yeah, it seems like a nothing chart to put up, but oh, there's so much to it. So, US imports from China are dropping fast. Yeah, dropping to a level where they were in, I don't know, March of 2024. So, roughly this time a year ago, not a big deal. But why they're dropping has more to do with the cost of trade coming from China. This chart, you may not see it, but it's bad for China. Why? Because if we are consuming less from China, we are their big client and consumer. They don't want to lose our wallet share,
They can't.
even if it's a few percentage points,
Mhm.
because they're not going to make it up and they will lose it forever to a competitor. Number one. Number two, they would rather deal with a margin decline, so make less money to maintain that wallet share. So, what does that mean? That means what we've been talking about for months. China is exporting deflation, and they will continue to export deflation to maintain their wallet share, seeing that they are an export based economy.
Mhm.
They want to maintain that money grab from us and the rest of the world, and they don't want to lose it to Vietnam and Europe and US and Canada and Mexico. So, what will they do? They'll compete on price. What does that look like to you? Regardless of the rate of tariff on Chinese things, China will likely adjust the price so there is no change net of the tariff rate. Oh boy, that is deflationary.
Mhm.
And I see that coming. Why? Because China can't afford to permanently lose the wallet share. They will temporarily lose profit margin to keep the cash flow coming
Mhm.
versus permanently losing a percentage of the client because it's very hard to make it back up,
Mhm. Yeah.
especially when you're a communist country and you are feared. If there is an alternative at the same price, other countries will do the same thing. They'll say, you know what, I'm going to go deal with a friendlier country that can't dominate us if we act up. So a few things. They either have to cut prices or be very friendly with everybody quickly. And I don't think they're going to be very friendly with anybody quickly. So
Mhm.
that means they'll probably cut prices to nullify any tariff. And that is the pinch that they will be feeling and are feeling right now.
And as I told you, my teenage girls have learned in economics 101 lesson watching TikTok and what the effect of inflation in China would do to the price of their Shein clothes that they're buying.
Yeah, so Shein is a very, 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 very low quality, low cost manufacturer of, clothing,
Mhm.
mostly amongst the teen and teenagers out there. You can spend $3 to $5 and get a shirt or a skirt. Now you wear it once and it disintegrates because the quality is terrible. But at the end of the day, there are a lot of people that buy higher quality clothing and they don't wear it more than once or twice anyways. So
Also in the press is all of these potential updates on the bill.
yeah, it's probably too soon to talk about this because it'll likely be modified to some degree. But the one big beautiful bill, it's like a soap opera title, right? The one big beautiful bill update. What are the big changes so far? The SALT deduction change from 10,000 to 40,000, but it does have a income phase out and cap to it, so don't
Yep.
get too excited. I think ultimately, if you have $40,000 of SALT deductions, your income more often than not is going to be well beyond the cap,
Hmm.
which means you may not get it. So be mindful of that. There is some pro business stuff in there. It's benefits for buying equipment, business activity, and manufacturing and building stuff and doing stuff where you can depreciate stuff quickly and completely. That's positive. So there's a whole host of things in there. There's like Section 899, which is a like a trade tool in tax policy, which is bizarre. Ultimately gives the government a lever to assess these tax rates on foreigners, foreign investing, and foreign swapping of dollars, and potentially some business stuff. I don't want to get into that yet because that's not final, and it's very likely that comes out if some of this trade stuff gets cleaned up. But there's a whole host of stuff in this bill. I think it will be a less big, not as beautiful bill by the time it's said and done. And I think we shouldn't expect it to pass. I think everyone's hearing like July. I'm going to go out on a limb and say Labor Day. So I'm going to go with
Fall.
September.
Okay.
Yeah. Yeah.
Yep.
Because this thing needs to be kicked around a little bit. I mean, even in the news, you're hearing Elon Musk, the short time ago friend of the administration, now is slamming this bill. So does that have any influence? We'll see.
Yeah.
So I wouldn't expect anything on this bill until September.
Yeah, that's a lot for them to get done during the summer.
Yeah, we'll be covering this in the next couple of months.
Yeah. And we talked earlier about the interest on our debt. And so we have a visual on this in terms of why rates need to be cut.
Yeah. So when you do hear things about deficits, I just want to clarify a few things. Any revenue from tariffs have not been scored into these calculations, right? So when you hear like the CBO or National Tax Foundation or all these entities that score the bill, number one is it's scoring on a static basis. So if there's no benefit to anything, just factor in the cost, right? That's not a great way to do it because that's not real life. That's just a simple math formula that a 12-year-old can do at home. So don't pay too much attention to that soundbite. You want it scored dynamically. So you want a dynamic scoring that does somewhat forecast the benefit of economic activity if there is more business demand for stuff that can be depreciated. If this rate comes down, this activity is generated. There's more of a dynamic scoring element to it. Number one. Number two, they will only score things static and dynamic based on what passes through Congress. And guess what hasn't passed through Congress? Tariffs. So none of the revenue from tariffs will be factored into this bill when you score it.
Mhm.
So it'll, of course, look like there's a bigger deficit until you net it out for the benefit of tariff income, and it squashes the deficit quite a bit. But there's a reason why no one wants to touch it that way. It's because they can only score things that have come through or are likely to come through Congress, and tariffs is not one of them. Let me
Mhm.
clarify that. The other side of it is, has anyone factored in the fact that the interest expense on our debt went from 600 billion to 1.2 trillion dollars? So all of a sudden there is a relative increase
Mhm.
of $600 billion that wasn't there a short time ago.
Mhm.
So, of course, we're going to be in a situation where we have a deficit because we have this new $1 trillion expense called interest. So, the government's credit card interest is a bear. It's the third largest expense in the world. And, the Federal Reserve, who never wants to touch fiscal policy or even give opinions on it, well, they have influenced it. Why? Because their monetary policy has forced the US government, when it has deficits, to issue debt at a significantly higher interest rate environment.
Mhm.
And that has to eventually enter into their formula
Mhm.
because they are impacting no other entity more than itself by having these high interest rates. Does that make sense?
Yeah.
The bank of itself is charging itself a rate that is too high. So it should help the cause by doing something. Yeah.
Nope.
So just be
Absolutely.
mindful of that when you hear deficit talk. Well, we have this new third largest expense that we have to deal with that came out of nowhere.
And last slide in terms of the economy and policy, but we have to talk about housing. It's amazing to see some of the shift that we've seen in this market in the last couple of years.
Yeah, again, this is a national lens, and I always have to hedge that because people listening in Connecticut are like, "What are you kidding me? There are no homes for sale, and the ones that are for sale need to be renovated, and they're all getting, their asking price." Yeah, that's Connecticut and parts of New England, but the rest of the country, there are a ton of homes for sale now, and there are a ton of sellers. So, this is a chart that shows that nationally, sellers outnumber buyers pretty significantly. There's about a 500,000 spread. And what does that do? Well, we're seeing it across the country. Home prices are coming down. There's still not a ton of activity because there still are a lot of people who are on the buy side. They're either waiting for financing or they're waiting for rates to decline. This will create probably another positive tailwind in the coming years when rates start to come down, and their influence on mortgage rates will create a lot more housing activity. Why do I say it's a positive tailwind? Nothing moves the needle in the economy like housing transactions because it's a big ticket item that spawns other big ticket items, right?
Mhm.
If you go and buy a burrito and a tube of toothpaste and I don't know, Tylenol, and that really doesn't move the needle. But if you're buying countertops and cabinets and refrigerators and concrete and
Hiring movers.
hiring movers and hiring contractors and all this stuff, that you have to think about the positive impact on employment, the positive impact on the economy. Housing activity is a very powerful positive punch to the economy. It gives it a nice boost, and that is on the horizon for sure.
Yeah.
This is shaping up to be a very high volume scenario, like lots of housing transactions starting maybe next year, maybe even the second half of this year. And usually the second half of the year isn't known for a lot of housing activity. I think we're going to see more than we've seen the second half of this year, and it could almost guarantee it for next year.
Okay. We're going to shift now into the everything else section, and we're going to start with nuclear energy.
Cute title. So green it glows. Yeah. So why? Well, we're taking a page out of the Paris Accord here in the United States of America under a Republican president, and we are following the most eco-friendly country, France. We're following their path. What are they doing? They're going nuclear. Why? Because they have to, and they know it's clean, and they're okay with people that are still stuck in the green glow years of Manhattan Project and plutonium and all that stuff because the process is very different today and it's much more controlled. It's way more efficient. And you can execute on this. This is a no brainer. The government has approved small modular reactor design. What does that mean? And they fast tracked it. That means we are going to see nuclear and more of it sooner than we thought. It used to be the going time frame to get anything nuclear done, if you were brave enough to push it and spend the money on it to potentially lose all your money, would be about 10 years, right? All the red tape in government and, it just didn't make sense financially.
Yeah.
Now you have some personnel changes and policy changes and sort of some fast pathing to get nuclear done, and as we should, because we need power. You cannot talk about artificial intelligence, cryptocurrency, electric vehicles in an eco-friendly environment without having nuclear. Why? Well, unless you want to run everything on coal and oil, which you don't want to do, you need nuclear. That is the solution. You cannot put enough solar panels and wind farms up to come close to the effectiveness of nuclear. So this is a good thing. And this is certainly a great investment theme because it impacts data centers, it impacts natural gas, um, it impacts everything.
Mhm.
Electricity pricing, our ability to go greener in the future, our ability to have EVs and hybrids. They have to plug into something. So more to come on this. But one interesting deal that just happened. So Meta, aka Facebook, they just signed this nuclear power deal with Constellation Energy that pretty much goes like this, just to tell you how forward thinking they are. They signed this deal where they're paying Constellation a fortune for energy that they have not produced yet, but they just want the promise to have it sometime in the future, and they're giving them money to help create it. Wild, wild.
Amazing.
Yeah. So this is a great theme that we invest in indirectly, because a lot of these underlying investments are incredibly volatile and they are so policy sensitive to tweets and changes in administrations and changes of key personnel and ideals and all this stuff. So, we're watching these very closely. We do certainly have exposure to the power complex, all flavors of it. And it's very likely we will be incrementally increasing our exposure to it in the coming quarters and years. So more to come on this. We will be talking about this more, we think.
Yeah, it's fascinating. There's been a lot of media attention around funding with universities. This is going to be a different twist. We're going to look at the endowments.
Yeah, so the Ivy League schools have been in the news a little bit, you think? I don't think so. It's bragging rights season for Ivy League schools and their endowments, right? They all compete on the sports fields and they beat their chest who wins, who lost, so on and so forth. But the end of June means it's the end of the fiscal year for these endowments and universities, and they used to brag about how well they did and that they beat everybody else. I don't know that they'll be bragging this year. Number one, because they're trying to claim poverty because the government has suspended some of the funding from them.
Mm.
Number two, because schools like Harvard have a $53 billion endowment. You can't claim poverty when you have a $53 billion rainy day fund and you're bragging about the fact that it makes 10% a year to infinity. You make almost $6 billion a year in income and return on it. Why do you need any money at all?
Mhm.
Right?
And
And
what are
you
they
get
taxed
mass
on that?
nothing. Julina, how dare you?
Exactly.
Anyways, same goes for Stanford. Yeah, look, if anyone wants to complain at an Ivy League school, it's Brown with a measly $7.2 billion. I don't feel so bad for them, but I think the bragging of how well and how big their endowments will likely not happen this year because they are trying to raise money in the bond market selling taxable municipal bonds. So stay tuned. June 30th is the fiscal year end. And keep in mind, when they quote their returns, they are trying to quote it in a way to compare it to market returns. But the market is usually measured on a calendar year basis. Endowments measure on a fiscal June 30 basis. So it's a half year, right? So it's a rolling half year versus the market that is different. I've seen so many comparisons that leave out that fact. You should be aware of that. It's a different measurement period. And if you did a study that we did here at Principal years ago, it's nothing that we published. I don't believe it was just something we did internal because sometimes that's what we do. It showed that their returns are shockingly similar to market returns, even when you adjust for risk. So you shouldn't be bragging about anything. Anyways, we'll move on from that one.
More to come.
More to
And
come.
what's really interesting is a lot of individuals may not be aware of this because the media didn't really talk a ton about this. The markets didn't really move much, but Moody's downgraded the US credit rating.
Yeah, it was a thing for about 30 seconds and then everyone got over it. So Moody's, one of the, big three credit rating agencies, downgraded the US debt from the best to one notch below the best. And they were the last entity to make that move. Fitch and Moody's already Fitch and S&P Global already did it, I think a year ago, 2 years ago, so on and so forth. It used to be a headline because it was so rare. Now it was just Moody's getting in line with the others. But it is funny, their chief economist, Mark Zandi, is actually quoted many times over the years saying that the governments should spend money and stimulate and run deficits because that spending creates more economic activity. So the same entity that employs this person who is their chief economist, touting the benefits of running deficits and spending money and creating economic growth, even if it's watered down, it's still growth. That entity says, yeah, because they did that, we are downgrading them. So take it with a grain of salt. Again, these rating agencies are the same agencies that rated AIG pristine, A rated, in the fall of 2008 as AIG was facing bankruptcy.
Hmm.
And then a month later, while they were struggling with the narrative and trying to avoid bankruptcy, they downgrade the company. It's like, well, where were you when things were declining? Which made it even worse for these companies. So
That
take
moved
this
the market.
that moved the market. Take all this with a grain of salt. The U.S. is the best place to be, and it could even be the best place to be in a bad neighborhood. But it has always been, and very likely will always be, the best place to be from a credit standpoint, liquidity standpoint, currency standpoint. So
As we end with some optimism here, I will also end by saying Happy Father's Day, Bob. Happy
thank you.
Father's Day to my husband, Doug, to all of my colleagues, to all of our clients, to everyone listening. I will falsely pretend that I created this slide. You have superpowers, right? You 100% fixing things, terrible jokes, life advice, patience, and an infinity amount of love.
Wow. I'll take it where I can get it, Julina. Thank you.
Yeah.
Awesome.
Yeah. We appreciate, as always, your time. We appreciate the trust that our clients have in us. And I hope that as we end this month for June, you again can sense the optimism. As Bob mentioned earlier on in the beginning of this, we will have a more in-depth mid-market outlook next month. So as always, more to come. But Bob, thank you as always for the insight.
We'll see you next month, and happy summer until then.